Alright, I'm going to be doing a tax problem. So here we have a company that's reporting a pre-tax income of $500,000 with a tax rate of 21%. We have a list of items here, and we're going to determine any deferred tax assets and liabilities, as well as recording the journal entry. So before getting into any numbers, we're going to talk about how we have some temporary differences and some permanent. The temporary being depreciation, warranty costs, and installment sales. These are essentially things that will reverse out in following years, hence being temporary, versus life insurance proceeds being permanent, which I'll explain a little bit more in a second here. So we have our book and our tax, book being what we report on our financial statements, and tax being what we report to the IRS. So for depreciation, we have a book amount of $40,000 and a tax amount of $70,000. For warranty, it's $15,000 and $5,000. Installment is $20,000 and $0, which I'll explain in a second. And then the same thing for life insurance. So for depreciation, and then we have our differences as well. So for depreciation, this could be something like a change in depreciation methods or something like that. And essentially, this is going to create a deferred tax liability because to the IRS, we're reporting $70,000 worth of depreciation expense. But then on our books, we're only recording $40,000. And so because to the IRS, we're saying we have more depreciation expense, that's going to reduce our net income more, which in the end is going to lead to paying less in taxes. And so you can kind of think of it as like they're skipping out on paying the taxes of $30,000 of depreciation expenses, if that makes sense. And so as a result, that's how we have this temporary difference here. This $30,000 will eventually reverse itself out as time passes. For warranty costs, it's a little bit different. This creates a deferred tax asset because something else to note is that for tax purposes, everything is off of the cash basis. So what matters is when cash changes hands. It's paid out or received, not accrual, like when it's earned or incurred. And so let's say the company sells, tech company, they sell a bunch of computers, and the computers have a warranty that come with it. The company sets aside $15,000 to cover the any warranty costs, expenses. As of now, the company will have to pay taxes on all $15,000, even though that's supposed to be deductible from taxes, because cash isn't actually. They haven't paid out anything. They haven't paid out any customers the amount needed to cover these warranty repairs or fixes, whatnot. And so that's why in the future, when they do pay out, they can deduct that amount or a portion of that amount based on their tax rate from their income. And so that's why we have this difference of $10,000, because we're saying like maybe they did pay out $5,000 worth of repairs. Well, that's still $10,000 that technically is deductible, but they can't actually deduct it yet because, again, cash hasn't changed. The company hasn't paid out cash still. For installment sales, this creates another deferred tax liability because the company recognized $20,000 in revenue for books, but for tax purposes, this revenue will not be taxed until the cash is collected in 2026. So again, this is like that cash basis I was talking about. As of right now, the company cannot be taxed on this $20,000 because they don't have it. They haven't collected $20,000. This is just revenue. But once they do get the $20,000 in 2026, well, now they have the money. They need to pay the tax on it. That's that reversing effect. The next year it reverses because they have the cash, and now the tax is owed. And then for life insurance proceeds, it's a little different. This is a permanent difference because life insurance proceeds cannot be taxed by the IRS. And so The company's going to recognize the $50,000, but they're not going to report anything to the IRS, and then that's not going to reverse out the next year because they won't ever be taxed on it. This is permanent. So here we have our pre-tax income. We want to find what's our taxable income, and then off of that, what's our income tax payable. So to begin our depreciation, again, the company's like quote unquote saving $30,000 of depreciation expense because they're reporting their tax expense higher, or their tax depreciation higher than their book depreciation, but we know that's going to reverse. So as of right now, they're saving money, yes, but this is going to reverse out in the next year or whenever. For warranty costs, we explain this adds back $10,000 as a tax asset. Again, because right now the company has to pay all the taxes on it, but once they actually pay money to repair a customer's computer, that's deductible from that year's taxes. Installment sales, again, deferred tax liability. They're saving money right now, yes, because they don't actually have to pay taxes on it because they don't have the cash for it still. But then the next year, this is going to reverse, and they're going to pay taxes on $20,000. And then finally, our life insurance proceeds. Again, they can't be taxed on it, so that just gets removed and it's permanent. So this does not reverse itself out. This is permanent, 100%. So then if we just add this all up, we get a taxable income of $410,000. And then if we want to find what's our income tax payable, we multiply our taxable income by our tax rate for this year, and we get $86,100. Cool. So now we want to do figure out our deferred tax assets and liabilities. So we know depreciation, warranty costs will create. I'm sorry, not warranty costs. The installment sale. These will create our deferred tax liabilities, and then the warranty costs will create our deferred tax assets. And then again, note how we're not putting life insurance proceeds under deferred tax liability because it's permanent. It doesn't reverse itself out. The deferred tax liabilities and assets only apply to the things that would reverse out because it's creating a future, obviously, liability or asset. So here, our difference is $30,000, but to find the actual liability, we need to multiply it by the tax rate, and then we're just going to assume that the tax rate remains the same for the next year, because this is based off of when you're calculating this, you want to use a tax rate for the year in which it will reverse out. The problem doesn't really specify like what is the tax rate going to be in the next years or following years, so we're just going to assume it's 21% for the foreseeable future. And we're going to do the same thing for installment sales, 21%, and same thing for our warranty costs, 21%. Cool. So now that we have our deferred tax liabilities and our deferred tax asset, we can create our journal entry to record everything. So we all know income tax expense is a debit. Expenses are debit, have a natural debit balance. And then we want to record our asset, our deferred tax asset. And then we also want to record our deferred tax liability. And then finally, our income tax payable. So now income tax expense is actually going to be a plug. We calculate this last because we know the company is going to pay $86,100 in taxes. That's set in stone, 100%. And this was again calculated by taking our taxable income, which was our pre-tax income, and then adjusted depending on any differences in like depreciation, warranty costs, installment sales, life insurance, if there's like municipal bond, I believe interest as well. You would adjust your pre-tax income for all those items to receive your taxable income and then multiply that by your tax rate. And then our deferred tax liability, we saw depreciation and installment sales. So we're just going to add these two together. And then our deferred tax asset, again, we calculated that as well. And then now we can simply solve for our income tax expense. And then here we have a balance of 96,600 on our credit side and 96,600 on our debit side. Everything balances, everything checks out. And then for my real world example, we can look at our Form 10K for Microsoft. Let's see if it works. It's been a little buggy, but if we go to our notes, no, yeah, it's being weird. I believe on page 75. Yes. So this is the notes to financial statements, but here we can see they actually list out their deferred income tax assets as well as deferred income tax liabilities. And yeah, you can just see the different, stock-based compensation expense, leasing liabilities, depreciation. We just did that, for example. This could have been a result of a change in depreciation methods. And then I also believe, no, okay. Well, yeah, but yeah, here we can see the deferred income or deferred tax assets and deferred tax liabilities in a real world setting. They're just included as a part or as a note to the financial statements. And like here, see here we have some definitions. Deferred income tax balances reflect the effects of temporary differences, which we explained were like depreciation, warranty costs, installment sales, between the carrying amounts of assets and liabilities and their tax bases, and are stated at the enacted tax rates expected to be in effect when the taxes are paid or recovered. So this is what I was kind of trying to explain in the problem, where for all the deferred tax items, you want to calculate them based on the year that they would reverse out. So say, for example, in 2026, a tax rate drops to 15%. Well, then for like installment sales, especially, we would actually multiply this 20,000 by 15%, because that's when the taxes will be paid on it, not 2025, which is based on the 21%. But that's essentially what this is saying at the end here. And yeah, that's my problem.